last few days, IT has done well too. And the reason why we decided to try and have a conversation with Nitin Rakesh of Mphasis is because there have been 2 or 3 brokerage notes in the last 2 or 3 days, which have all been talking about how this company is probably coming out from a bit of a lull, and the outlook ahead could be very good because the size of the deal wins are going up and the quantum of deal wins are also going up. And both Morgan Stanley, Avendus, etc., everybody, the worst is behind. So let's get in Nitin Rakesh to talk about everything under the sun when it comes to IT and Mphasis. Nitin, great having you. Thanks so much for joining in. Let me begin by asking you whether the micro and the macro are in favor for tech stocks, because rate cuts coming off or rate cuts coming on could actually be construed very positively for tech companies.
So I think 2 or 3 things to talk about when you think about, firstly, client priorities, and then, of course, the macroeconomic picture itself. If you look at the client priorities, I think the themes have been pretty consistent for the last few quarters, except that now we are starting to see a little bit more ambition and desire from enterprise customers to see how they can now start scaling some of their AI initiatives. Now, that's not a standalone in itself, because the broader priorities around transformation, adoption of cloud, use of data, kind of all feed into the same narrative around what's the best way to do enterprise AI at scale. So I think that's just given a little bit more of an impetus in the recent couple of quarters to conversations and potentially application of AI. Now, if you're positioned on the right side of this trade, what I mean by that is if you have a lot more to gain and a lot less to lose, because at some level, deploying AI into large existing engagements can also be a headwind. But I think if you're positioned right, then this is definitely unlocking opportunities for companies with the right set of value proposition and the right set of AI-led offerings to be able to construct some large transactions. Good examples: AI ops, modernization, data modernization, as well as applications, and potentially finding ways to bundle some of these propositions with a savings-led mindset. So that's the first one. So I think there is appetite to look at engagements, constructs, where this becomes a trigger for some large deal conversations to happen. Second, if you look at the macroeconomic environment, I think there are 2 things that have happened in the last 2 quarters since April or so. I think there was a lot of fear around tariffs and what that will mean to US growth and inflation. Some of those fears have been tempered because the growth's actually held up quite nicely and inflation hasn't really picked up in any major way. If anything, I think there is more consensus around the fact that this may be the right time for the next set of rate cuts to happen. Remember, rate cuts happened in last September, but the 10-year actually went the other way after the rate cuts because of these fears and issues. And I think that seems to be tempering a little bit for sure. Not that the tariff or geopolitical environment has become more conducive. It's just that it's been absorbed, it's been analyzed, and there's a little bit more comfort around the fact that we are finally at a point where the equilibrium will tip towards a softer rate environment. And that definitely has implications on 2 fronts. One, again, remember, we were waiting for a recession for the last 3 years, right? That takes that out of the picture because we are potentially getting to a point where, without really breaking down the growth momentum, we are getting to a rate cut cycle. 2, it also means that there are certain cyclical businesses that get impacted. I think for us, there's definitely 2 or 3 segments of the business that have a macro dependence. And as we had called out even back in July, I think the upside risk from macro softening was really not part of the equation when we looked at the rest of the year. So I think those are kind of the yin and the yang of what's going on with macro, from an economic standpoint. And of course, we can talk a little bit more about clients.
Yeah, so could you talk about that? Are client conversations improving, Nitin?
I would say the appetite to do transformation AI-led deals is definitely improved for 2 reasons. One, I think every enterprise has over the last 12, 18 months done a fair amount of work around hardening their stance on AI, understanding where the application happens. Some forward-leaning ones have actually gone ahead and built their own AI fabric and the environment to be able to consume AI resources at scale. and some haven't. The ones that have are now looking for scale. The ones that haven't are now looking for help in actually getting there. So it's definitely at least as I said, for the right companies positioned with the right stance, this has definitely become an interesting tailwind.
Got it. Brokerages, Nitin, are saying that the size of the deal wins, quarterly deal wins, are inching up from a run rate of $300-400 million to higher, and there is a rising conversion of deal wins. Could this be true?
Yeah, I think again, if you look at just the numbers, we've had almost $1 billion in deals done in the last 2 quarters, which is definitely a much higher run rate of TCV closure. And I think part of the confidence that at least the market is seeing is also coming from the fact that for almost all business lines, barring maybe one, we had a pretty strong growth even in Q1 26. To a point that I think for at least BFS, even insurance, TMT, that is translating into revenue growth as well. So I think the premise that we had a fairly strong pipeline growth now converting in pipeline into TCV is going forward, looking to translate into revenue growth is the premise that I think they're looking at, and some of that we called out. I think it's just the fact that market takes some time to digest the commentary and the narrative, and at this point, I think we are really focused on executing to that narrative.
Nitin, then the question is about employees, right? And more employees or less employees may not be symptomatic for more business or less business. But how does one understand hirings versus business?
That is a little bit of a complicated equation, but let me answer that by telling you that until the last 2 or 3 years, there was a fairly linear correlation between revenue growth and headcount growth. And I think the reason for that was that no matter how you structured a contract, fixed price, managed services, managed outcomes, time and material, managed capacity, these are various contract types that exist in our industry. The fundamental equation always was you would translate a body of work into a headcount plan. They could be on-site, offshore. There was a pyramid element to it. But in the end, it was all based off of the effort required to deliver. Then you can convert that effort, by dividing it by the number of widgets into a managed service price or a per transaction price, but it was still effort-based. I think the foundational shift that we are going through right now is it's not just going to be people-based effort anymore. And I think we will always need people to deliver because in the end, we are a services business. Industry provides a certain service, but we are now starting to move away from pure people-based services to a combination of people and technology being orchestrated together into a solution. And the way to price for that isn't just a plain staffing estimate plus margin equals price. So the linear correlation between revenue growth and headcount growth is the one that is actually in debate right now, whether if that linear correlation was fairly high, maybe let's say 0.9 or 1, will that go down to 0.6, 0.7? And so that's question number one. And I think we've seen some evidence of the fact that if you play this right, you have the ability to bundle technology and people together into a solution. And the second question really is, what do you bundle along with people? Do you really build your own platforms? Do you go to market and partner with platforms that are available to be bundled into your solution? How does a client pay for those platforms? So I think we are definitely in the transition phase. If the answer was clear, the industry would be at a very different place. But that's the beauty of pivots, that as you're in the pivot, that presents some outsized opportunity and potentially, ability to get some operating leverage, back in the business as well. But I think the key thing is we will definitely need people to deliver. We may need a different type of talent, right? Even if you take something as simple as, writing software, we're starting to think a little bit different about what's the right, way to write software. Is it, do you expect a software engineer to actually write every line of code, or are you deploying, these code writing AI solutions within an enterprise environment to actually configure code and assemble code? So I think all of that is being debated and discussed, and in a way, there are some large, initiatives that every enterprise is undertaking as well. So that's a long way of saying that the type of solutions, how we bundle them, how we structure them, how we price for them, and how we deliver them are all really going through a bit of a shift. And depending on how quickly or constructively and creatively we can make the shift, is definitely presenting some outsized opportunities. And of course, the double-edged sword is that it's also opening up some new threats, because if you don't need that many people and your business is people-based, then what happens to revenue line? So I think that's the pivot that we are in right now.
And wishing you the best for this pivot and more, Nitin. Thanks so much for taking the time out and being with us.